Hey everyone, today I'm going to be talking about The Intelligent Investor, a book written by Benjamin Graham in 1949. It was read by Warren Buffett at age 19. He was so inspired by it that he later decided to study under Ben Graham at Columbia. So Buffett has a lot of qualities that made him who he is today. He has entrepreneurial savvy, negotiation prowess, and he's accumulated a lot of experience. But maybe the trait that's been the most contributing to his success is his endless pursuit of knowledge. So his reading The Intelligent Investor was part of that. So as part of my report, I'll talk about the background of the author Ben Graham, the lessons that I took away from the book, and the impact that it's had on investors worldwide for 70 years since it's been written. So Ben Graham was a famed economist and investor, known as the father of value investing. He was born in the UK. He immigrated to New York City as an infant. In 1914, at 20 years old, he graduated from Columbia. He started working out on Wall Street. He worked there for 15 years. He met Jerome Newman. He formed the Graham-Newman partnership. And with Newman, he used what he called value investment strategies to find individual stocks with the best value rather than look at the stock market from a macro perspective. And in this manner, he made a lot of money. But unfortunately, in 1929, following the stock market crash, he lost a lot of his assets. And after this, he returned to Columbia, and he developed a new strategy for investing. He wanted to buy stock in companies that had shares that trade below liquidation value, which is basically how much a company sells for if it goes bankrupt. So with all this in mind, he also studied market psychology, so basically how investors feel after purchasing a given stock and how this affects prices. So with all this in mind, with fellow Columbia Professor David Dodd, he wrote Security Analysis, his first book, which discusses the difference between true investments and mere speculation. And after about a decade and a half more at Columbia, he co-wrote The Intelligent Investor with David Dodd in 1949. So 3 lessons that I took away from the book are the first lesson was value investing, or determining the true value of a given stock, regardless of its current trading price. So someone can find this by looking at assets, earnings, dividend payouts, other financial measures, and comparing it to the face value. So basically, if the assets and earnings are greater than what the face value price is, the investor should buy the stock and hold it until what Graham calls a mean reversion occurs. So in a mean reversion, the true value and face value converge, and at that point, the investor can sell. And another thing that Graham talks about is the margin of safety, which talks about leaving a small margin for error for the investor. So this can be done by buying undervalued stocks that later become more valuable. And other ways include irrationality of other investors, the inability to predict the future, and a volatile stock market. And third lesson that I took away was that of Mr. Market, which is a hypothetical person that Graham uses to symbolize the entire market. And every day, Mr. Market goes to the shareholder's office. He asks the shareholder whether he wants to buy or sell stock in Mr. Market's company. Every day he comes back with a different price. Sometimes the price is right, other times it's too high, other times it's too low. And basically what Graham is trying to say here is that individual investors don't necessarily have to listen to Mr. Market all the time. Instead, they can look at other indicators of performance, like the assets and earnings, rather than what the general market speculates in a given day. And talking about impact, since 1949, when it was published, The Intelligent Investor has been read by millions worldwide hoping to get an edge on investing, including Warren Buffett himself. So Buffett, along with a cohort of his peers, have been called the super investors of Graham and Doddsville. All of these guys were students of Graham and his colleague David Dodd, and all of them employed what Graham called value investing when going into the stock market. So other investors alongside Buffett in this cohort included Charlie Munger and hedge fund manager Walter Schloss. And on average, all of these super investors had a yearly return of 20%, regularly outgained the S&P 500. They're living proof that the Intelligent Investor's value investing works. So in all, the Intelligent Investor has been widely acclaimed. I highly recommend it, and the lessons are pretty timeless. They're good for new investors and experienced investors, and it's something that every investor should read, regardless of whether it's your first investment or your 100th. Thank you.